we can quickly go through the equity market update for the December 2025 and what is the outlook for the upcoming months. Right. So with that, let's get started. So here is the screen shared. With that, we will be covering the topics such as market overview, then factory strategy performance analysis, market structure, growth dynamics, valuation, and investor behavior, key insight and takeaway. So stay tuned. This is going to be an interesting one. I will try to cover up very quickly and to the interest of everyone. Uh, 2025 is a year of divergence. As you all know, most of the investors' folio is stuck, or either they are seeing some negative returns compared to previous years, right? So that is where, and you can clearly see there is a tug of war. Different economic structures are fighting with each other's factor rotation, quality, or then we have value, momentum, balanced. All these are like rotating and structural type. So we'll see about this. So complete performance picture here, you will see that S&P has been performed very good. S&P is the US based index, has been performed very good in last 1 year. Europe has also given a very good returns, right? But once it comes to Indian market, you could see that Indian market could not perform as expected with respect to the US or Europe territory. And even those who are into the small cap returns are not up to the mark. So most of the small cap and mid cap returns are at break even, or they are lower than the expected, right? So that's about it. Let's move on. A decade of Indian equities. So what happens generally, we try to chase where the returns comes, but that is not the case always. So the cycle keeps on rotating. You can see there are four primary indices that we have considered: Nifty 50, Nifty Next 50, mid cap, and small cap. Right. So every year on year return, you can clearly see every year on year returns here. When 15 to 17, everyone was performing good. 17, 18, there was a jerk. Small cap couldn't perform as expected. 18, small cap didn't, but then small cap picked up. 21, 22, little bit on or did not perform from the small cap point of view, then it could pick up. So if you see overall, the mid cap and the small cap could have been given a very good consistent return, right? That's what we could see here. Mid cap overall given 18, and this 50 next 50 TRI has given 14.46, right? So despite of high annual spikes, higher volatility in small cap impacts long-term compounding. Mid cap and large cap indices show superior consistency over last 10-year window. So large cap and mid cap sectors has been outperformed. That is what we know. Factors performance review. So mainly we'll look at to the quality factor. So S&P quality factor has given very good returns in last 1 year. Europe quality factor has also given positive returns. Nifty quality factor could not perform. Same with NJ based quality factor did not perform as expected. Right. So that's about the quality factor. Momentum. So momentum is like we choose the stocks where momentum is building up and we can expect a quick jump into that stock. So that's where this momentum factor comes into the picture. Like sectorial, there will be a shift like that. So here in this momentum, you could see that S&P momentum has given 1 year return positive. Europe has given positive, but when it comes to Nifty 500 momentum has faced a structural weakness. So momentum as such could not perform. Moving to enhanced value. Value factors saw explosive growth in European market and healthy domestic market returns, though the model portfolio show mixed result. So enhanced value has been given a very good return even in Indian market, but looks to be good. Then the stocks that has selected based on low volatility, like a large cap or very, very large cap. So with respect to market volatility, the performance is okay, but this stock has given a positive performance year on year. So that is the low volatility stocks. Multi-factor, considering the two or more factors simultaneously and deriving an index based on that. Definitely European market, US market has given very good more returns. Nifty and NJ multi-factor has given positive return. That is very nice. Coming to domestic markets for last 1 year, uh, yeah, these are the like point to point. Nifty could see 11% returns. Small cap and quality could not perform. Small cap and quality could not perform at the same top. Momentum stock did not perform. Okay, so value volatility they are giving positive. Small cap mid cap sector did not perform as expected for last 1 year. So that is about domestic marketing. Explosive growth in leading indices. So growth in Nifty 50 market, the investment wise, Nifty 50 has demonstrated orbitable growth, nearly tripling its market capitalization from lows of 2020. This showcased the strong recovery and sustained momentum of Indian top blue companies. Even though market has been going up and down, the overall market capital is increasing. Right. Growth of Nifty 50 market in lakh. Nifty, this is 50 and 500 also has been seen the growth. So this is like 500 and this is 50. So that's good that overall there is a growth in overall market cap. So market is positive. NSE growth in total market cap. This is in spite of index overall growth in NSE market. You could see that started for 112 and this is more than 410. Total market capitalization of NSE listed company has grown by a phenomenal 265% since 2020, illustrating an immense expansion of the entire equity market. Nifty 50, Nifty 500 as a percent of NSE market cap. So despite there is absolute growth, the market share of both Nifty 50 and Nifty 500 has trended downwards, indicating that growing portion of the market expansion is occurring outside the top tier indices. Okay, so what has happened? The overall market has been a consistent growth, but whereas Nifty 50 and Nifty 500, there is relatively percentage wise growth has been slowed out. So definitely there is investment, but not directly into Nifty 500 and Nifty. There might be some other uh, investment option that people are looking into, right? Current period. This is very good, Rishabh. A very good slide. Most of my friends see that, say that now is that market has given very good return and it's the time to stop thinking of investing until it comes down to a level of previous low on monthly, previous low on weekly. So uh, not to worry. Let's go into the details. Current PE ratio, 1 year PE ratio for indices. Okay, yeah, indices. So you could see that 1 year median and current median. So auto sector definitely performed better in last 1 year. Bank is average. Financial is down. FMCG is down. Then Nifty IT is down. Metal is down. Pharma is down. Reality is down. Healthcare is down. So for the 1 year median, if you compare to the previous 1 year, the median wise, only auto sector has performed better. And if you come to the indices, like Nifty 50 has almost stable. Next, Nifty is kind of stable, but not as such. Mid cap has given negative median. Small cap is little bit same, and Nifty 500 is also little bit same. So if you see Nifty 50, Nifty 500 with respect to 1 year, it's now it comes to the 5 years. 5 years how the profit earning ratio. So it's something similar. Now you understand the analogy. Now what is the learning from here? A clear valuation divergence is visible. Large cap indices Nifty 50, Next 50, and key sectors like auto and banking are trading at discount to their 5 year median PE, suggesting a potential value. So this is like auto with respect to 5 years, it didn't perform, and same with the bank. There is a scope that this will pick up with respect to 5 years gap. Conversely, mid cap and small cap indices are trading at a premium with variation of 7 to 11% above their historical value. So if you see mid cap, it is above by 7%. Small cap is almost above their 7% on an average P ratio. Okay, average P ratio. That is what it is. So this is giving an overall outlook that Nifty auto and bank are at discount. Nifty mid cap, Nifty small cap is kind of higher valued by 7 to 11%, and that way we can make a investment strategy. Price to book ratio. The chart displays a clear valuation divergence. Large cap indices like Nifty 50 are trading below their 3 years median, suggesting relative undervaluation in star contracts. Nifty mid cap is trading at a significant premium, 32 to its historical median. So Nifty mid cap is outperforming, but Nifty 50 and next 50 are just below their value. Okay. Small cap is also kind of little bit outperforming. Looking at the indices, extending the look back to 5 years reinforces the trend. Nifty 50's valuation appears even more attractive. The trading at 11.5% discount. The premium of Nifty mid caps remains. The mid cap is at higher valued. Expansion valued this segment. So small cap and mid cap, the mid cap 150, 250 are trading at significant premium compared to both their 3 year and 5 year median PB price to book ratios, highlighting potentially stretched valuation to this segment. Okay, so mid cap and small cap suggesting that uh, kind of a stretched valuation. Dividend yield analysis. So the companies which are giving good dividend and consistent dividend, the analysis based on that, the market segment, the current dividend yield is lower than 3 years median. The Nifty small cap index shows the most significant deviation, which is currently 32.2. So Nifty small cap is showing that lowest dividend. In a 5 year comparison confirms the trend. Suppose suppress dividend yield across board. The Nifty small cap remains notably low below its 5 year median, reinforcing the theme of lower income potential relative to recent history. So small cap most impacted. The dividend yield for the small cap 250 index is the most suppressed relative to its history, which combined its high PB ratio points to a market driven more by growth expectation than value. Consistent market, unlike PB ratio, which showed a clear divergence, the dividend yield data represent a consistent trend of lower yield across all market cap segments, suggesting a broad market phenomena. Institutional tug of war, foreign caution versus domestic conviction. So you could see that Continuously you must have heard that FIR selling, FIR selling, FIR selling, FIR selling, FIR selling, FIR selling. There was a small buying here, but at the same time, domestic institutionals are buying. Right? So domestic capital acted as a critical shock absorber, providing stability and cushioning to the market against significant foreign outflow throughout the 2025. The scale of DI investment, particularly in month with heavily FII selling like January and August, underscore the domestic investor base, broad foreign sentiment, and retail volatility. FPI has demonstrated a significant net flow in 2025 with major withdrawal concentrated in the first and third quarter, intercepted with brief periods of positive investment. Individual investor sentiment was characterized by strong net inflows by the start of the year, followed by sustained period of outflows mid-year and a volatile second half year. Markets monthly pulse, capturing short-term dynamism. So this is giving like overall the market pulse where the people were looking for investment and all this. So here you can see that there is a volatility, both primary and secondary market exhibit volatility, short-term volatility, with monthly capital raised via IPOs fluctuating more dramatically than trading turnover. Peak IPO activity in late 2025 did not directly correlate with the highest market turnover which occurred in June, indicating different drivers for investor participant in the capital raising. Okay, there are different drivers for investors in capital raising. Market structural growth, a story of deepening and expansion. IPOs, you could see that IPOs investment has been extensively increased. Preferential allotment, QIPs, rights, FPOs. Investor base showcase unprecedented expansion in STL CDSL. While IPOs lead 1.38 lakh crores, secondary mobilization right QIP prep cumulative exceeds primary issuance 1.54 lakhs. The investor base has witnessed a 5x expansion over 6 years, driven largely by CDSL, which grew from 2.11 CR to 16.16 CR. A consistent year-on growth in active accounts indicates that a structural shift to household saving towards equity market. A consistent year-to-year growth in active account indicates that structural shift in household saving towards equity market. That's very much, I think, what we have learned is that the Indian market reliance foreign capital as Indian market reliance on foreign capital has fundamentally shifted. We know more like driven by FII's investment. The structural rise of domestic investor provides a powerful cushion and is now primarily driven for the market behavior. So we are not by FI leaders. With inconsistent leadership and widening valuation gap between segments, a disciplined data-driven approach is critical to identify opportunity and manage the risk. So this is why we need someone to guide us in this journey. With inconsistent leaderships and widening valuations gap between the segments, you could see that the leadership decisions across the world are not consistent. In such scenario, a disciplined data-driven approach is critical to identify the opportunities and manage the risk. Disciplined data-driven approach is critical to identify opportunities and manage the risk. All right, so with this, I would like to end this video. I hope I have made some value to you, and that's what my purpose is. If you have any questions, keep posted. We'll try to resolve as soon as possible, and stay tuned for more interesting videos. Thank you.